All right, so let's try this again. Bob, I'm going to add you back in. All right, here we go. So let's start back over. First things first, we got the jobs report today. So Bob, if you just want to start there, what does that tell us about the job market and inflation?
Well, the jobs report was much stronger than expected. So that's good news because job market's strong still. The problem is they want to see a slightly weaker job market because it's a way of fighting inflation and getting inflation down. It's too high. So the good news is we have a strong jobs report and it's undermining this whole imminent recession narrative. So remember, there's two stories here. One is the inflation worries, and the other is that we're going to have a recession in 2023. Inflation is showing signs of peaking, although today's data on jobs wasn't very helpful. In particular, we have a wage component. Average hourly jobs, average hourly wages that clearly indicate that wages are still increasing and high. Now that's good news generally, but remember, the Federal Reserve wants the economy to slow down, and they want inflation to slow down. So while it's good news that the job market is still, it helps the idea that it's going to be hard to go into a recession in 2023 when the job market is this strong. It undermines the Federal Reserve because they want inflation generally to come down. And we had very strong wage growth still. And one of the components of inflation is wage growth. So this is I call it the bizarro world where it's good news that the economy is growing and wages are strong, but the stronger they are, the more inflation stays high. And we don't want inflation to stay high. So this is the really difficult part to explain to people. It sounds like it's good news, and in theory it is, but it's not really. And so that's why the stock market's down today. In theory, a lot of big things are happening that are good. And in theory, the economy is still very strong, and that's good. But the Federal Reserve wants the economy to slow down to fight inflation. Really strong job growth, really high wage growth doesn't help that narrative. And that's kind of why the stock market is down today. I know that's very confusing for a lot of people, and I get a lot of mail saying, let me get this straight, Bob. What you want here is you guys are rooting for the economy to slow down. And bizarrely, yeah, because that's what the Federal Reserve wants, because if it doesn't slow down, inflation is not going to slow down. And because of that, the Fed's going to keep interest rates really high for a long time. And nobody really wants that. So that's the sort of, I call it the bizarro world that we live in.
So Bob, another interesting dynamic that we've been seeing is recently stocks have been rising, but earnings estimates, they've been falling. So, what does that mean for investors?
Well, something's wrong here. In generally, when earnings are going down, notably, there's a lot of worries about 2023. So the whole debate is, what side of the earnings recession are you on? Do you think there's going to be a recession in 2023 in general? How bad is it? Or is it just going to be a soft landing? A really serious recession invariably involves earnings going down. And that's why the stock market goes down, because earnings go down. Well, how much will earnings go down? Well, we don't know. I mean, it's really kind of hard to figure this out. But generally, right now, analysts are expecting earnings to be up slightly, like 3 or 4% in 2023. Most of the strategists on the street, the people who look at the economy and make estimates about the stock market from there, don't agree with that. Most of them think it's going to be flat to down. And there are some people who think that the earnings are going to be down 15 or 20%. That's a recession. That's an earnings recession. And so what side of this debate are you on? The problem here is, in general, estimates for 2023 for corporate earnings are going down. And they're essentially flat now. And as I said, some people think they're going to be down 15 or 20%. Well, okay, but the stock market's going up. It's off of the October lows. It's 15% above the low we hit in October. That's still down for the year, 14% or so. So it's not great, but the trend has been rising for stocks, not going down recently. So somebody's kind of wrong here. And I think the problem is nobody really can understand what kind of soft landing, hard landing we're going to get in the economy. We just don't know. Our knowledge is not that good at figuring this out. This is a very strange situation. This was caused by a global pandemic that created enormous supply chain problems. It was also caused by a Russia invasion of Ukraine that nobody foresaw, that drove up global commodity prices. These two events have created a real mess. On top of that, we've had artificially low interest rates for a long time that the Federal Reserve has kept in to keep the economy going since the financial crisis in 2008 and 2009. So you got a whole real strange mix of things going on. And you want to put it simply, cluelessness levels are very high, higher than I've ever seen. And I don't blame people for being clueless. The result is very wide dispersions of opinions. You have people who think that earnings are going to be down 20% next year, and you have people who think that earnings are going to be fine next year, up, flat to up slightly. That's a big, wide dispersion of opinions, and it goes back to that cluelessness.
So, Bob, let's jump into one sector of the market, and that's energy. So, energy is the best performing sector this year. Oil stocks are up 60% as a group and very close to their highs for the year. But oil is 40% below where it was earlier in the year. So, can you explain this big difference between oil and oil stocks?
Yeah, it's the same thing as what I just said before. There's a contradiction here. You know, I said stocks are going up, but earnings are going down. That's kind of hard you can't have that happen for any long periods of time. It doesn't make a lot of sense. Well, you have the same problem with oil and oil stocks. Generally, not always, but oil and oil stocks tend to move in the same direction. If you think about it, the primary mover of oil stocks is the price of oil. Some companies, have greater exposure to oil than others, but generally oil and oil stocks move in pretty much the same direction, but they haven't in the last several months. So the price of oil has been way down. Oil was close to $120. Now it's $80. I mean, you're talking 40% lower than it was. Yet energy stocks have been going up. And there are many energy stocks that were at new highs just not long ago, a couple weeks ago. Well, again, this doesn't make sense. Oil is going down. Oil stocks are going up. Somebody's wrong. And most of the time, it's about a debate about where oil is going, which is related to the global economy. So what side of the oil debate are you on? And again, more cluelessness. Sorry to keep using that word, but that's what it is. Nobody knows what's going to happen in the global economy next year. You have a very complicated situation because China is the #2 economy in the world. They're the second largest consumer of oil. Well, guess what? China's been shutting down because of COVID. They have the zero COVID policy, which is kind of crazy, but they do. And the question is that going to continue in 2023? Well, if it is, then demand for oil might be suppressed, lower. If it's not, then demand for oil is going to be higher. Well, that'll affect the price of oil. A lot more demand out there for oil, it's going to change the price of oil. So simply put, China is a big problem for oil. What side of the debate are you on? What side of the debate are you on the Russia-Ukraine thing? Is it going to be a resolution in 2023 or is it going to continue? Russia's supply of oil, they're trying to prevent Russian oil from going on the global market. It's still there, but that's an issue. So tell me what's going to happen there. Then you have the general situation, and that's suppressing demand for oil in Europe too, just driving generally. And then you have the United States. Are we going to be in a serious recession or not? Is the economy going to slow down a lot or not? That's going to affect the price of oil. So what you have, again, is it's the same with the analysts and the earnings. You have an unusually wide dispersion of opinions. So there are people out there who think oil is going to be $60 in 2023 because the economy is going to be terrible. Europe's going to be terrible. China demand's going to drop. And then there's people who think oil is going to be over $100 because the global economy is going to do better than people think. There'll be a resolution in Ukraine. China will stop this zero COVID policy nonsense. So tell me, what's the right answer? When you have people that think oil is going to be 60 and you have people who think oil is going to be 120, That's a crazy dispersion. That's crazy wide estimate. Normally, in a normal year, when you don't have crazy things going on, everybody has differences of opinion, but the differences of opinions are narrow. So instead of $60 oil, some people saying 120, you might have people thinking that there's $80 oil or $90 oil. The bandwidth is very small of opinions, but here it's all over the place. It's the same with the earnings I mentioned earlier. It's all over the place. This tells you, I've been doing this 30 years, this tells you that people are clueless, that they really don't understand what's going on. It's not because they're stupid. It's because the potential outcomes are very wide. So again, I'm sorry to repeat myself, but it's important to understand this. On oil, what's going to happen with China and the Chinese economy and COVID in 2023? What's going to happen with the Ukraine crisis? And how is that going to affect global oil and Europe? And finally, what's going to happen with the US economy? And that's going to affect the price of oil. These are like really hard things to figure out. And one could be positive for oil and the other could be negative for oil. So you see how tough this is, Katie, to figure out? Imagine trying to be a poor oil analyst who's supposed to guess the price of, what the price of Exxon should be 1 year from now. I can assure you any attempt to figure that out is, I don't want to say it's not worth a lot. I'm just saying the potential outcomes are so wide because of the variables I cited, China, Ukraine, US economy, that, I would take any estimate with a grain of salt.
Yeah, well, there are certainly a lot of unanswered questions, things up in the air at this point. So we will wait and see and follow along closely and see if we can get some of those questions answered. So, Bob, another thing that people are, always talking about these days is inflation. So will inflation come down next year given all of the Fed's rate hikes?
Well, yeah, here's the problem. There's a lot of parts of inflation. So if you look at the consumer price index, there's a lot of different parts of it. And I don't want to do, an academic lesson about this. But for example, rents and housing is a big part of the consumer price index. They have a thing called owner's equivalent rent, which is essentially housing costs in there. Well, rents have been very high and going up, but they're moderating now and they're showing some signs of cracking, which is good, but they're still high. In other words, if rents are up 10%, I'm just picking a number, year over year, it very rarely, you're up 10% in 1 month, and then all of a sudden you're down 15% the next month, year over year. It doesn't happen that way. It's usually much more gradual. So the housing market and the rental market have shown signs of peaking in terms of increases, but it's coming down very slowly. So that's an issue. We don't know where that's going, but it's moving in the right direction. Then there's goods inflation. We all know about these supply chain bottlenecks that COVID created. So the cost of shipping stuff has gone through the roof. That's beginning to moderate a bit globally and in the United States. That's a good sign. So the goods cost. Something that is not moderating is wage inflation. So look at today, what happened with wage inflation. We had not only month over month wage inflation is up 0.6% month over month wages. The expectation would be up 0.3%, but even year over year, wages were up 5.1% year over year. And it was expected to be up 4.6. You might say, who cares about 0.5%? Actually, that's a pretty big number when you're dealing with the US economy. So wage inflation is very sticky. Housing inflation, rental inflation, high, but showing signs of declining. Goods inflation, the cost of shipping things, cost of producing things, up, elevated, but showing signs of declining. Wage inflation, not so much showing a lot of signs of declining. And that's a problem because that's a big component of the whole consumer price index, the CPI. And think about it. People don't, when they start seeing goods go up, they anchor this in their head. Oh my God, inflation's really going up. I got to keep asking for a raise. Even if I just got a 5% raise, I'm going to ask for another 5% raise. That's how people think. It's called anchoring. You just, you think about the last number you heard. Oh my God, inflation's still up 7%. All right. I'm going to ignore the fact that it was up 8% a couple months ago and it's coming down. It's still up. I want more money. I want another 5% raise. So wages are very sticky. Wage inflation is very sticky. People keep asking for more. And that's really difficult to get to stop. And the problem here is the Federal Reserve is going to look at that and they're going to say, well, we're just going to keep interest rates higher for longer. So the hope was the Federal Reserve would start lowering interest rates in, I don't know, the second quarter or the third quarter of next year, because the economy is going to slow down just enough for everyone to be happy and the Federal Reserve will be happy and inflation will stop being so crazy. Well, if wage inflation stays up, even if housing costs go down, even if the cost of shipping goods goes down, that's good. But if wage inflation stays up, the Federal Reserve is still going to keep interest rates higher for longer. And that's why the stock market gets freaked out about this stuff. Higher for longer is still bad. It may be not be, we're just going to keep raising rates. Okay, we're going to raise them and then stop, but we're going to keep them high for a long period. No, that's not good. They don't want that. Think about mortgage rates. Mortgage rates were over 7% for a 30-year mortgage. Now they're down to 6.6%. Hey, that's good. Okay, it's going down. It's going in the right direction. But if a year from now it's still 6.6%, they don't want that. People want lower mortgage rates because it helps improve the housing market. You saw what happened. Housing prices came down the minute mortgage rates started going up. So higher for longer, that's not the narrative you want. You want to believe someday, sometime in the near future, next 6 months or so, the Federal Reserve is going to stop all this and start lowering interest rates. Well, they got to see some signs that it's going in the right direction. That's the issue.
Yeah, definitely something that we'll be watching closely. So next up, Bob, what would need to happen in order to avoid a recession next year? What are your thoughts?
Well, look what happened today. You know, there's two ways to read this. I told you before, this jobs report. The jobs report is still good. It's lower than it was. Job creation, which is what the jobs report showed today, was lower than it was earlier this year, but still strong, stronger than people thought it would be. Well, think about it. That's actually pretty good news. One of the reasons that the market's not fallen down even more is this whole idea there's going to be an imminent serious recession, is not clear at all. It's going to be very hard to have a recession with jobs still strong like this. You usually get a recession, there's jobs decline. They don't go up. The number of jobs that are out there per job applicant is extraordinarily high. There's something like 1.7 job postings for every person looking for a job. That's very high. So you can't have a recession with the job market this strong. This is good news. Yes, see? But remember, this inflation story and recession is very intertwined. So the big story in 2022 is inflation. The Fed's trying to stop inflation by raising interest rates. The big story for 2023 is, will this induce a serious recession or not? The bulls are saying, maybe we can avoid it. Maybe we can slow down the economy just enough and have a soft landing. And, job growth will slow down, but the economy, it won't get really bad. There won't be millions of people out of work. There'll just be fewer job openings that are out there. The market, it's called a tighter labor market. That's what the Federal Reserve loves this word, tight. Tight means there's less supply of jobs out there. So who knows? Maybe. I think today's report was encouraging in terms of the fact that the economy is continuing to hold up very well. And I think one of the reasons the stock market's not down much today is they like this narrative that, okay, things are slowing down, but doesn't look like we're going to have an imminent recession. They certainly like that idea.
So, Bob, another area that I want to talk about is tech. So when will tech bounce back?
Well, I don't know. And I'll tell you why it's a problem. Technology is a growth sector, and tech stocks tend to thrive in a low interest rate environment. So what does it mean when you have a tech stock? What is it? It's a growth stock. What does that mean? In technology, you're basically buying on the come. You're buying for companies that have earnings growth prospects that are very robust in the future. So this is all air. This is all hope. It's hopium. You're literally buying companies that say, that company, that semiconductor company looks like it's going to make a hell of a lot of money. 2 years from now, because the market for whatever semiconductors they make is growing fast. Well, reasonable guess, but it's all based on hopium. Here's the other thing. If you have these stocks are much higher risk because they have a higher reward. Remember, the stock market is based on the idea of pay me a dividend or pay me from some future stream of earnings that you can buy back stocks and increase the earnings per share, something like that. If you have a high interest rate environment, these higher risk stocks, they compete against the bond market. So at 1% for a 10 yield for a 10-year bond, why would anybody do that? It doesn't make a lot of sense. But if the economy is slowing down and all of a sudden you have 4% or 5% yield for a 10-year bond, hey, you know, that's pretty good. There are people out there who will turn around and they'll say, you know what? These tech stocks are risky to own and they're expensive. Maybe I'll just take a 5% yield on a 10-year because that's guaranteed money. You're going to get your money back. The U.S. government's not going to default. You buy a 10-year, it's paying 4%. You're going to get 4% and you're going to get your money back in 10 years. For some people, when you're dealing with the stock market and you'd say, okay, maybe in a good situation, I could do 3 or 4% more on growth stocks, on technology stocks, that 3 or 4% better than that. But hell, I don't know. The market could get weird here. The economy could get weird. There's too much risk associated with owning technology stocks just for 3 or 4% more versus owning a 4 or 5% bond that's guaranteed. You see, it's the risk reward ratio. I can get a bond at 4% today, risk free. I don't know what I could get a return on growth stocks right now because I don't know what the economy is going to look like next year. It's a mess. Nobody has a clue. Okay, you know what? I'm going to take some money off the table. I'm buying bonds for the moment. Maybe if the economy dramatically improves or we show signs it will, tech stocks will come back a little bit, but you'd have to have a situation where the economy improves and interest rates go down. And, you know, the answer is yes, tech stocks can come back, but those are kind of the conditions you would need to have that happen.
So, Bob, we've talked a bit about your new book recently. So your book, Shut Up and Keep Talking, Lessons on Life and Investing from the Floor of the New York Stock Exchange. And in it, you talk a lot about long-term investing. So what is your best financial advice for young adults?
Well, there is a chapter in the book where I talk about my whole investing journey and how I started. My father tried to get me interested in the stock market in 1970 when I was 14 years old. And there's a whole chapter about this in the book. I ignored him. He was an investor in the market and was quite a Horatio Alger type, really believed in the stock market because he thought it represented America. And he tried to interest me in it. And I described what he told me in 1970. And I ignored it. I not only ignored him in 1970, my generation didn't care about the stock market. We didn't care about investing. We didn't care about savings. We went out and traveled around and had a great time. In the 70s were a lot of fun, believe me, I think. And into the 80s. I didn't actually start investing until 1993, 3 years after I joined CNBC. And by then I was pretty old. I was 7 years old by then. So think about this. I had to take more risk when I finally understood what was going on. And I described what I did and how I owned it. And the mistake I made was not investing when my father told me to. Had I done that, you would have had much longer opportunity to invest. Investing is a long game. And the beauty of investing is that it involves compounding interest, which is the greatest financial instrument ever created. So think about this. The stock market, on average, goes up about 10% a year. For the last 100 years, that's the average. Now, this year it's down. But on average, that's about what it goes up. Adjusted for inflation, it goes up 6 or 7%, somewhere around there. That beats bonds, it beats real estate, it beats any other investment. But it really matters if you do it over long periods. So the difference between, if you think about it, let's assume you're 25 years old. You're going to live probably you're going to live 100. Work on that. You're going to live 75 more years. The difference between starting to invest when you're 25 and starting to invest when you're 40, when you have your investment grow 10% a year is enormous. And that's because of compounding interest. So think about this. You have $1,000. You put it in a fund that invests in the S&P 500, biggest 500 stocks. After 1 year, you're up 10%. So you have $1,100. $100 is 10% of that. Next year, because of the beauty of compounding interest, if you do nothing and the market's up 10% again, you not only have another 10%, you have 10% on the $100. So you have $1,210. And then the year after that, you have 10% on that $10 additionally. This is what compounding interest does. And it doesn't sound like a lot in the beginning, but when you go out 20 or 30 years, that $1,000 compounds dramatically out there. So there's a huge difference between starting at 25 and starting at 40. What happened to me was I saw this and I had to take a lot more risk. Basically own almost nothing but stocks. And that's a little higher risk, but I don't think that much when you're a younger person. So my advice is start early. If you have a 401k, you generally will have a matching plan by your company. It's free money. Comcast does a match for a Comcast employee up to, I believe, 7%. So the company will give you a 7% raise every year for free if you put 7% of your savings of your salary into a 401k program. That's free money, and start it early. Don't worry about asset allocation. Don't worry, I don't know how to pick stocks. I don't know how to pick bonds. Buy a simple index fund. The S&P 500 is my main holding. People look at me and they want to know, don't you own something really sophisticated, like Malaysian bonds or something? I said, no, I don't. It's in the book what I own. Anybody's interested, you can see it. And I would encourage people not only to invest early, invest as much as you can. Don't worry about the asset allocation. Just own the broad stock market and don't market time. This is the second most important thing. You'll think that you'll know when to go in and out of the market. Market timing involves I'm going in now, and then I'm going to wait, and then I'm going to sell, and then I'm going to do it all over again. You think you know. You don't. You think you know when to go in and go out. You don't. Market timing is a mistake because you have to get going in right and going out right. And nobody does that. Nobody gets that right. And in the book, there are examples where I can show you $1,000 invested in the S&P 500 50 years ago grows to over $100,000 today because of what's happened in the last 50 years. But if you're not in the stock market on the best day of the last 50 years, you have less money. If you're not in the best 5 days, you have even less money. If you're not in the best 25 days, you have less than half of it. Now you might say, well, gee, then I should know what the best 25 days are. I agree, you should know, but nobody knows. Nobody knows anything. Nobody knows when the best 25 days in the last 50 years are going to be. Nobody knows when the worst 25 days are going to be. You don't know, so you have to play the market averages. What you have to believe is that long term, the stock market goes up. It does go up. 3 out of 4 years, the stock market has been up in the last 100 years. 3 out of 4 years, on average, 10%. That beats everything else long term. Not necessarily every year. Don't expect that. But long term, that's what happens. So you're playing an odds game, a long, long odds game. You're betting that generally the stock market rises and generally you're going to keep putting money in and the compounding interest is going to win. Finally, I just want to answer this one question that people ask me. Why does the stock market outperform? Why is the stock market have such strong returns? And the reason it happens is capitalism. Capitalism is a system whereby the means of production are primarily owned by individuals and corporations, which are legal entities in the United States and around the world. The United States has a very particular kind of capitalism called market capitalism that we practice. In market capitalism, generally, most of the means of production is controlled by individuals and corporations. These individuals and corporations are very good at very efficient allocators of capital. What does that mean? It means they fire people and hire people depending upon their interests so that they can return a profit. If you're owning a pizza shop, You want to have the maximum number of employees to generate enough profits to make the most money. If you don't, you fire people. If you think you have more, you want to buy a pizza oven, you borrow money, and you might want to hire more people. Make decisions based on profitability. Corporations do the same thing. Now, there are other capitalist countries that are not exactly the same. So in France, for example, it's a capitalist country, but they have what you would call more state capitalism. State capitalism is where the government has ownership of a higher percentage of the means of production. So they may own certain industries in France that are largely controlled by the government, that are not controlled by the government here in the United States. State capitalism is fine, but it tends not to produce the same returns for people, for the state, as it does, as private investment does, because the state is not as an efficient allocator of capital as it is. If you ever deal with state employees, you might know that. The reason the stock market in the United States tends to outperform other systems around the world is the way we practice capitalism. Now, you can argue, I don't like this kind of capitalism. It's too ruthless. I want more social justice, you know, whatever you want to say. And that's a perfectly valid discussion to have. However, I'm not addressing that. I'm addressing why does the stock market in the United States tend to outperform everything else. And it has to do with capitalism and the way it's practiced here in the United States. And I personally am in favor of that kind of capitalism, although I agree with some of the points on social justice. Sorry to digress here, but it's important for people to understand what exactly goes on in the United States.
Yeah, I think that's definitely helpful for people to understand, Bob. And also back to what you were saying in the beginning, I'm sure a lot of people, you know, that are invested now wish they had started sooner. So that's really great advice. And also, like you said in your book, you really lay out exactly what you own. And I think that's also helpful for people to see. It doesn't have to be.
This is one of the chapters. If you really are curious, I show you. And it's not complicated at all. I own the S&P 500. I own a mid-cap index fund. I own a small cap value fund. And people look at, I could put it on an index card and show it to you. And people always are disappointed when I explain it. They think that somehow there's going to be some stunningly sophisticated, complicated, you know, I'm going to own options and Malaysian bonds. And I don't own any of that stuff. I just don't. I'm telling you, you think you're brilliant. You think you can outsmart the market. I long ago gave up such illusions. I believe in investing, and I believe in staying invested long term.
Well, that's great advice. No need to overcomplicate things. Keep it simple and long term. So thanks, Bob, for answering all of our questions, as always. And thank you to everyone who tuned in for this week of Market Matters. And we'll talk again soon.
Thanks,
Bob.
Katie. Thanks, everybody, for the questions. Great job, as always.